Chapter 1. Introduction to Investments. Have you ever seen a century-long growth chart of the S&P 500? You will be amazed by the incredible growth of the stocks as a whole. A century full of events. This period has a Great Recession, a World War, over 30-year-long Cold War, multiple financial crises, the oil embargo, market melt-ups and meltdowns, bubbles and recessions, and every possible thing in between. However, stocks as a whole kept going up because stocks are not merely a stock market ticker. They are proportionate shares in profit-making businesses, and over time profit accumulates. You will notice a little indentation around 1930. This tiny indentation represents the 1929 market meltdown. Over the 3 years, from 1929 to 1932, stocks lost 90% of their value. How insignificant it looks now in the greater scheme of things. Hardly noticeable. Shouldn't you ignore it if you are a long-term investor? Remember, this is a 90% decline from its top. People committed suicide, and a whole generation couldn't gather the courage to invest in stocks again. It was, and still is, the largest drop from the market top. Today, it doesn't seem to matter. You would have multiplied your capital hundreds of folds along with all the dividends you would have received in these 90 years. And this is true whether you buy at the top of the market in 1929 or at the bottom of the market in 1932. The only mistake is not to participate in the earnings and growth of businesses. The biggest risk of all is not taking one. Melody Hobson. However, timing is essential even in the long term. The person who bought at the bottom of the market in 1932 would be 10 times richer than the person who bought at the top of the market in 1929. The most important thing is to invest and buy shares in successful businesses. The second most important thing is to buy right and to not pay excessive amounts. Why invest? How many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. Robert G. Allen. Putting money in a savings account is not going to make anybody rich. It is making the depositors poor every day if you count the inflation. Usually, the savings account's rates is well below the prevailing inflation rate. To accumulate any wealth, you must invest at a growth rate higher than inflation. There are several options, some better than others. We will discuss common investment options and their risks and benefits in Chapter 2. I can assume if you are reading this book, you have already taken the first step in your mind, or maybe you are miles into your investment journey. You must start investing as early as possible. Yesterday was better than today, and today is better than tomorrow. Don't wait for a significant market drop. Warren Buffett, the legendary investor, was once told to hold on to his $10,000 and wait for Dow Industrial Average to go back down to 200. It never did. In his own words, Warren Buffett said, if I had taken their advice, I would have $10,000 even now. Should everybody invest? Everyone has the brain power to follow the stock market. If you made it through 5th grade math, you can do it. Peter Lynch. Yes, everybody can and should invest even in the stock market. It is true that picking stocks and investing in individual securities is not for everybody. Investing in individual stocks requires skills, knowledge, and patience. If you have some working knowledge of business and accounting and have a lot of patience to ride out market ups and downs, you can be a stock picker. You just need to understand that stocks are proportionate ownership of earning businesses. Markets can be volatile from time to time. However, stock prices follow earnings accumulation over the long term. Stocks are not market tickers represented by daily quotes, but proportionate ownership of businesses, and should be viewed accordingly. Unfortunately, not everybody can think rationally in market meltdowns. Average investors of individual securities often make irrational decisions and buy and sell at the wrong time. However, many investment vehicles like low-cost broad market index funds are specifically designed to serve investors who are not equipped or willing to take individual securities risk. Is the market rigged? Of course, the market is rigged, and it is rigged in favor of long-term individual investors. Think about it. Long-term trajectory of the stock market is upward because a portfolio of stocks is making money and accumulating profits. Broad market indexes, like S&P 500, must rise over the long term. The upward path is the only logical direction. Prices can be suppressed for a short period, but eventually, the index will continue its course. All governments are on the side of long-term investors. The government does everything to avoid a market meltdown and will provide substantial support in recessions. Take any market meltdown as a test case. The government flooded the market with money and tried extremely hard to revive the confidence of the general public in capital markets. Support from the government was always there whenever capital markets needed it, and will be there in the future. The greatest fear of a professional investor who manages money for a living is capital withdrawals at the wrong time. The irrational behavior of investors can significantly damage a fund's performance. History has witnessed that capital is withdrawn at the worst possible time by individual investors. Any investment strategy can be ruined by ill-timed capital flight, and that's why professional money managers try to limit the options of their clients in respect of capital withdrawals. Even Warren Buffett, when running his partnerships, put limits on capital withdrawals. His investors could only withdraw on one specific day per year. For the rest of the year, capital withdrawals were not permitted. Secondly, professional money managers need to report to their investors on a periodic basis, quarterly and annually. A lousy quarter is compensated by an excellent one, but a terrible year lives in the records forever. Money managers tend to make irrational decisions just to protect their calendar year performances, even if they believe that decision is not in the best interest of investors. Annual performance means nothing to individual investors. The correct period to judge performance is from a market peak to another peak, or at least to the next all-time high. Individual investors have significant advantages over professional money managers. Retail investors, like you and I, have nobody to report. We have no benchmark to beat and have no fear of capital flight. There are no quarter and year ends, and performance is not linked to calendars. Professional money managers have information bias in their favor. They have quick access to critical news and have the ability to obtain and analyze large data. However, this information bias is only a short-term advantage. For a long-term investor, this advantage is more or less irrelevant. A long-term individual investor is in the best position to beat the market because 1. The market's long-term trajectory is upward, which is the only direction the market can go over a long period. 2. The government wants to keep the capital markets healthy and thriving. They will do whatever in their power to avoid or reverse a recession. 3. Capital withdrawals by investors can torpedo investment strategies of money managers at the worst possible time. Retail investors do not suffer this disadvantage. 4. Professional money managers are worried about their annual results and may take irrational decisions to protect their performance record. Individual investors have nobody to report, and yearly performance does not mean anything to them. 5. The advantage of the information bias in favor of professional money managers and large investors is almost irrelevant for a long-term investor. Because of the advantages mentioned above, long-term retail investors as a group beat the market with a significant margin. After long-term individual investors, the next category, in terms of advantage, is long-term money managers. Professional traders who engage in short-term strategies are the next. Short-term individual traders are the last in the line. Indeed, some individual traders make money, but a vast majority end up losing all or a portion of their capital. What is risk? The conventional definition of risk is the fluctuation of price. However, the actual risk is the permanent loss of capital, or, to a lesser extent, a subpar return. Temporary volatility in market price is not a real risk. You should view short-term price volatility as an opportunity. It is a window to either dump your unwanted positions or purchase more of your favorite assets. How do you feel, and what do you do when the Black Friday sale is on? You feel happy and purchase your desired items. If you are a buyer, then you should feel happy when stocks go on sale. Recessions are there to take your investment game to the next level. A recession should help you reach your targets sooner. However, all capital investments inherently suffer the risk of permanent capital loss. As an investor, it is your job to differentiate between market volatility and a permanent capital loss. You can only achieve this when you fundamentally understand why you bought the asset in the first place. Why most traders lose money. It is a fact that most traders, especially retail traders, lose money over time. It is widely claimed among the retail traders community that only 10% of active traders make money in the long run. I don't know how accurate this number is, but it is correct that most traders lose money. Even traders acknowledge this fact and do trading with an acceptance that it is only a 10% chance to make money, let alone beat the market. There are specific reasons why most traders lose over the long term, and there are ways you can avoid being one of the losers. Incorrect or incomplete understanding of the risk. When you invest in stocks or any other asset, your primary risk is the permanent loss of capital. Your secondary risk is a subpar return, and that's it. You don't have any other risk. However, most people take volatility in price as the prime risk. Market volatility can be a part of the total risk for money managers, but short-term volatility means nothing other than an opportunity for retail investors. Because of this incorrect understanding of actual risk, retail investors buy and sell precisely at the wrong time. They invest hand over fist at the market peaks and sell right at the market bottoms. History is the witness of this behavior over and over again. Investors are the stewards of capital, whether professional money manager or retail. Their primary job is to safeguard the capital, and the second task is to allocate the money to earn the maximum possible returns. However, maximizing the returns cannot be at the cost of capital loss. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Warren Buffett. All investment options have their own set of pros and cons, risks and benefits. It is your job as a steward of capital to understand the associated risk before allocating any money. Gambling mindset. Most of the traders think and act like gamblers. They believe that they can outsmart the rest of the players with the help of a trading system. They take investing as a game, and daily quotes are their scorecards. If you want to have gambling fun and thrill, go to Vegas. Serious investing is not gambling and should not be taken as a game of chance. Investing should be based on facts, not hopes. There is no guarantee that all investments will result in profits, but a carefully chosen portfolio of assets is highly likely to grow over time. On the other hand, the house always wins, and gamblers invariably lose over the long term. So, if you act and behave like a gambler, you will lose in the long run. Hoping for a bigger idiot. You can buy two types of assets. Either you buy an earning asset like rental property, a shop, agricultural land, a bond, or a proportionate share in a business traded in the public market. All of these assets earn money over time and grow in value. Alternatively, you can buy a non-earning asset, and your only hope is to sell to somebody else at a higher price. This strategy is like an idiot is hoping for a bigger idiot. You can call it anything, but it is not investing. Gold, paintings, or Bitcoin are all examples of buying a bigger idiot type of asset. You can be lucky and find a bigger idiot most of the time, but if you consistently play the same game, once in a while, you will be the biggest idiot. You will find yourself holding the bag all the way down to market bottoms. Paying more than fair value. Prudent investing is all about buying the right assets at the right price. Most of the assets can be a good investment if you buy at the right price. To evaluate the right price, you need to value the asset. The number one reason people lose money in investing is because they buy assets without giving any thought whatsoever to the fair value. If investors do not know or never attempt to know the fair value, they can pay any price. More often, the price they pay is far greater than the actual value. There are several ways to value an asset. However, the most common method is discounted cash flows. To calculate the value with this method, you take all the expected cash inflows from the asset and discount it with an appropriate rate of return. This method is industry standard, but the fair value calculated with this method is subject to significant assumptions. Fair value calculated by two individuals can be meaningfully different. It all depends on underlying assumptions. If you are assuming a 5% revenue growth and I am assuming a 6%, fair values calculated by us would be significantly different. Revenue growth is one assumption, and fair value is generally calculated with hundreds of different variables. Trading. Traders as a group always fall short of investors. Traders try to beat the market, but don't understand that cumulatively they are the market. Trading stock is merely writing and rewriting names on a register. No matter what, how often stocks change hands, this activity does not produce anything. Trading is not only a zero-sum game, but an aggregate negative after deducting the trading cost and research expenses. Somebody's gain is somebody's loss, so the professional traders win the game because they have significant advantages over retail traders. Investment decisions based on hopes, not facts. Retail traders often purchase investments solely based on hope. They don't try to gather and understand objective facts. Chat groups, colleagues, friends and family, and TV and YouTube gurus are their sources for information. Their talking points are primarily subjective without numbers. For example, this company is the largest fertilizer manufacturer. This statement can be true but meaningless without the context of numbers and facts. How about competition, margins, product viability, and so on? Subjective statements lead investors to buy assets on hopes. When prices fail to reflect their hopes, they quickly get rid of the investment on a small loss and buy another hope and repeat. If your investment decision is anchored with objective facts, it will be more comfortable to ride out market fluctuations. Improper diversification. Not having a properly diversified portfolio is one of the leading causes why traders lose money. A concentrated portfolio is not a comfortable ride. It is challenging for traders or investors to keep their emotions in check if a significant amount of their capital is at risk. In volatile markets, traders are more likely to make irrational decisions if their portfolio is concentrated, mostly when the price action is the prime reason to purchase the stock in the first place. Cognitive biases. Traders and investors are humans, full of emotions, behavior biases, and good and bad past experiences. We don't have much control over psychological shortcomings, and we routinely make decisions contaminated with our emotions and biases. Occasionally, irrational choices turn out to be the best, but most of the time, these decisions cause harm to our portfolio performance. Leveraging. It is an old Wall Street saying, bulls make money, bears make money, pigs get slaughtered. Another reason for the subpar performance of traders is over-leveraging. In a trending market, anybody who is following the trend makes money. Frequently, traders leverage their capital multiple times to magnify the gains. It feels terrific as long as you are winning. However, leveraged portfolios make excessive losses once the market reverses its course. These losses can be fatal to your trading account. Often leveraged positions are forced to close by the brokers precisely at the wrong time. Leveraging is not evil, but must be used with extreme caution and care. You must understand that over-leveraging is the prime reason for all market blowups. Prudent investing is all about harnessing the magic of compounding. A modest rate of return can accumulate a fortune over time. You don't need to beat the market, do over-leveraging, or pick the best stock to be rich. You just need to earn a decent rate of return and let your money compound over time. Don't try to chase wealth in the stock market. Wait patiently and let the money come to you. Compounding has a snowball effect. It is just a tiny ball of snow at the very start, but it can turn into an avalanche over time. Not ready to learn. The majority of traders or even investors think or at least behave in such a manner that it is somebody else's job to learn all the market secrets, bundle it in an easy-to-follow strategy, and let them know confidentially. They resist or sometimes even refuse to learn. I know people who repeatedly jump from one guru to the next in search of the holy grail of trading. Of course, it doesn't exist, but you need to know this fact to stop looking for it. Most of the traders spend hours after hours learning about the news. However, all of this is learning about events. Real learning is the thorough understanding of the concepts, not events or numbers. In March 2009, the market bottom was 59% from its top. What difference does it make if the bottom was 58% or 60%? What difference does it make that the bottom was reached in March, not in February or April of the same year, or a different year altogether? Does it matter that toxic asset-backed securities caused the market meltdown? All these facts are either numbers or news. The concept that must be learned is that the market can and does fall substantially from its top, periodically. Date, scale, and reason can and will be different each time. Investors must spend a substantial portion of the time learning and studying essential concepts of the investment business if they want to beat the market by a considerable margin. Staring at the screen all day long doesn't serve any good. It means nothing if you are not buying or selling. Watching every tick up and every tick down is just wasting your valuable time. Do yourself a favor and pick up a book or two about investing each month. Consider this an essential activity of the business. Chapter takeaways. The most important thing is to invest. The second most important thing is to buy well. A steady upward trajectory is the only logical path for the stock market because shares are proportionate ownerships in profit-making businesses, and over time, profit accumulates. Everybody has the ability to invest in capital markets. You don't need to be a super genius to do well in the investment business. The market is rigged in favor of long-term retail investors like you and me. We have substantial advantages over any other group of investors, even over professional money managers. Short-term price fluctuation is not the real risk. It is an opportunity.